right now as we track the live movement on the market floor. ACHR Aviation Inc. is trading at exactly 6.90 USD. The stock is navigating a complex intraday session, showing a mix of consolidation and slight upward pressure, currently up about 0.36% on the day. We are seeing volumes ticking over the 3.9 million mark already in the first hour of trading, suggesting that despite the broader market noise, eyes are firmly fixed on this ticker. If you are watching this chart on your Interactive Brokers trading platform or checking your Robinhood app, you are likely seeing the candles flicker with that characteristic volatility that defines the eVTOL sector right now. The market is trying to decide if this price level is a floor or a trap, and that indecision is exactly where the opportunity for analysis lies. The expectation for ACHR Aviation has long been a binary bet. Either they certify the midnight aircraft and we all start flying over traffic, or they run out of cash and the equity goes to zero. That is the simple, surface-level narrative you will find if you scroll through forums on SoFi Invest or read the headlines on most investing sites. Investors expect a story of cash burn, regulatory delays, and a wait-and-see approach that could last years. However, the reality emerging from their recent strategic shifts is far more nuanced and, frankly, far more aggressive than the flying taxi label suggests. The reality is that ACHR is quietly pivoting from being solely a service operator to becoming a critical aerospace supplier and infrastructure owner, a move that fundamentally alters the risk profile of the company. While the street worries about passenger safety certifications, ACHR is signing deals to put their electric powertrains into military drones and buying airports. This disconnect between the public perception of a sci-fi gamble and the actual execution of a diversified aerospace industrialist is the curiosity loop we need to explore. Let's look at the immediate context of this price action. The stock has been under pressure recently, and if you hold ACHR stock in your Fidelity brokerage account, you have likely felt the squeeze. We have seen a pullback following the Q3 earnings, where, despite narrowing losses, the broader skepticism about the timeline for commercial operations weighed heavy. But look closer at the tape. The selling pressure has been met with significant absorption. We saw news recently that Heights Capital Management exited their position entirely, selling over 2 million shares. When a major institution leaves, it often triggers a retail panic, yet the stock is holding the 6.80 to 7.00 USD range with surprising resilience. This suggests that the shares being dumped by the doubters are being scooped up by those with a different thesis. Adding to the noise, we have seen insider selling from the chief legal officer and the CTO. On the surface, insider selling looks bad. It always does. But context is everything in self-investing. These sales were largely to cover tax obligations related to vesting shares. It is a mechanical function of compensation, not necessarily a vote of no confidence, yet the algorithm-driven headlines you see on your Fidelity mobile app or Schwab Intelligent Portfolio's newsfeed often lack that context, driving fear where understanding is required. The real story, the one that challenges the bearish thesis, is the deal with Anduril Industries. This is the development that forces us to rethink the valuation. ACHR is not just waiting to carry passengers. They are now supplying their proprietary electric powertrain technology to Anduril for the Oman autonomous air vehicle. This is a defense application. Why does this matter? Because the defense sector doesn't care about the same consumer comfort and safety certifications that the FAA requires for carrying a grandmother across Manhattan. Defense contracts are sticky, they are lucrative, and they provide immediate validation of the technology. If the U.S. military and defense contractors trust ACHR's battery and motor tech for their assets, it serves as a massive stamp of approval for the engineering. It transforms ACHR from being a pre-revenue speculation into a legitimate aerospace supplier. When you look at NVIDIA stock, you see a company that became the backbone of an industry. ACHR supplying powertrains is a move in that direction, becoming the Intel Inside for the next generation of electric aviation, regardless of who flies the plane. This is a revenue stream that can turn on much faster than the commercial air taxi service, bridging the infamous valley of death that kills so many hardware startups. Furthermore, consider the acquisition of the Hawthorne Airport. This caught many off guard. Why is a tech company buying physical real estate? This is where the strategy exceeds expectations. By controlling the ground infrastructure, ACHR is securing its operational hub for the Los Angeles network, specifically targeting the 2028 Olympics. This is not just about having a place to park, it's about controlling the gate. In the world of airlines, slots and gates are the most valuable assets. By owning the vertiport location, ACHR insulates itself from rent hikes and operational constraints. It's a move reminiscent of how McDonald's is fundamentally a real estate company. If you are analyzing this on your SoFi trading platform or discussing it in investment help forums, you have to ask, is the market valuing the real estate and the defense contracts, or is it still just pricing in the uncertainty of the air taxi service? Let's pivot to the broader financials because the numbers from the recent quarter paint a picture of disciplined cash management. ACHR reported a net loss of $130 million for the third quarter. While a loss is never good in a vacuum, it was a significant improvement over the previous quarters and better than many feared. More importantly, they met their revenue forecast of $2.81 million. It's small, but it's precise. Accuracy and guidance builds trust with Wall Street. But the metric that matters most is the cash position. They are sitting on roughly $1.64 billion in liquidity. This is the fortress. In a high-interest rate environment, cash is oxygen. Many competitors in the eVTOL space are running on fumes, desperate for capital that is becoming expensive to access. ACHR's balance sheet allows them to weather the regulatory storm that might drown others. When you compare this to the early days of Tesla stock, the difference between survival and failure was often just access to capital during the ramp-up phase. ACHR has that buffer. If you are using Fidelity Wealth Management or managing your own Fidelity IRAs, you know that liquidity risk is the silent killer of growth stocks. ACHR has largely mitigated that risk for the next few years. Now I want you to pause and engage with this for a second. The defense pivot is controversial to some who wanted a pure green energy transportation play. What is your take? Comment below how many shares of ACHR Aviation you currently hold, or tell me if the partnership with a defense contractor like Anduril makes you more or less bullish on the long-term prospects. I want to know if you see this as a smart diversification or a drift from the mission. Let's widen the lens to the sector momentum. The eVTOL space is entering the show-me phase. The hype cycle is over. The era of PowerPoint presentations raising millions of dollars has ended. Now it's about flight tests and manufacturing. ACHR is winning here because of their relationship with Stellantis. This is another aspect often overlooked by the casual observer using Robinhood investments or browsing investing sites. Stellantis is not just an investor, they are the manufacturing partner. They are building the factory in Georgia. This means that ACHR doesn't have to learn how to mass-produce vehicles from scratch, a mistake that plagued Tesla stock for years during production hell. ACHR is leveraging the century of manufacturing DNA that Stellantis holds. They are aiming to produce 650 aircraft annually at scale. This industrial capability is what separates a science project from a business. When you invest online, you are often buying the team and the partners as much as the product. Having a global auto giant managing your assembly line is a massive competitive advantage that is currently undervalued by the market. The Midnight aircraft itself is moving through the FAA certification process. We know they received the final airworthiness criteria, a major regulatory milestone. The testing is ongoing, and the company is targeting commercial operations in the UAE by late 2025 or 2026. The UAE focus is strategic. The regulatory environment there is often faster to adapt to new technologies, allowing ACHR to log real flight hours and generate revenue while the FAA moves at its own pace in the US. It's a dual-track strategy. aggressive deployment in the Middle East to prove the model, and methodical certification in the U.S. to capture the massive domestic market. This global approach mitigates the risk of a single regulator stalling the entire company. If you are watching the flows on Interactive Brokers' trading screens, you might notice that news from the UAE often correlates with volume spikes. Smart money is watching the desert, not just the Hudson River. However, we must address the skepticism. The bear case is not without merit. The timeline for FAA certification is notoriously slippery. A delay of 6 months burns through tens of millions of dollars. There is also the issue of air traffic management. Integrating thousands of air taxis into urban airspace is a logistical nightmare that software is only beginning to solve. And then there is the public perception. Will people actually get in these things? Safety